AI ETFs making new multi-week lows, AI ETFs making new multi-week highs. I quantify it all on today's REKTelligence report. As a friendly reminder, everything in today's show is for informational purposes only. There is no investment advice given. All right, let's get into the show. Hey everyone, welcome. I'm Dave Bush. This is the Thursday Edge Report where I quantify specific opportunities in stocks, ETFs, crypto, commodities, sometimes credit. And today it's all about AI. I've got 4 different ETFs in the artificial intelligence sector that we're going to dissect, quantify, and see what's a good opportunity, all that ahead. It's all stock market today, specifically AI ETFs. Let's get right into the first. We're going to start with the Global X AI and Technology ETF, which is AIQ, which just dropped 7.5% inside of 20 days. And you see, this has happened a couple times, in fact, on this daily chart, which goes back to last August. And let's take a look at the hold times for this particular setup. Again, AIQ dropping 7.5% inside of 20 days. But first, let's just take a look at the holdings for this Global X ETF. And you can see the first thing up top holding here is just 3.92%. So we don't have huge concentrated holdings in this particular ETF. It's pretty broad and it's also global, right? Samsung up top, SK Hynix Inc. second, then TSM, Apple, Cisco, Broadcom, and down the list. NVIDIA is also there, kind of mid-column on the left-hand side. So lots of holdings here. Let's get into the performance with a 10-day hold. And there have been 31 instances in its history for this particular condition with a 10-day hold. And this goes back to May of 2018 to the present. So this hasn't been around for a huge amount of time, but this has set up quite frequently. Total P&L over 100%, and the hit rate or profitability 67.74%, 21 out of 31, and profit factor really solid at 2.658. That means that's over 2.5 times the amount of profit versus loss. Obviously, that's a good metric. 1 is break even. Let's go to that little box on the left-hand side. You'll see average trade, 2.55%, and the real max drawdown, I want to explain this, 6.2%. When you see the drawdown in TradingView where it says max equity drawdown up top, that is their definition of drawdown. And it's very useful. It has meaning, of course. It's closer to a max adverse excursion. You can read about it. I won't go all into it now. And it's the biggest max adverse excursion of all trades in the test. But real max drawdown on the left-hand side, which I've added, this is the standard definition of peak to trough. So that is 26.2% here. A couple other ratios I'm going to explain later, so I'm going to leave those alone now. But generally, 10-day hold under this scenario for AIQ, nice looking equity curve. Let's move out to 1-month exit. We have fewer instances now, just 25. And this is, of course, because a longer hold time means less time for another setup with a shorter hold time. So there are fewer instances. P&L is a little bit lower, but average trade is a little bit greater, right? We have fewer instances here, and the total P&L is roughly the same. So the average trade goes up just south of 3%. Max drawdown, a little bit worse, I believe, 27.64%. I'm going to cover those other ratios later. And the hit rate, 60%, is decent. Profit factor, also decent at just north of 2. It's an okay equity curve. Let's look at a 2-month hold. And you see that total P&L here is about the same. It's a little bit south of that. Average trade has gone up, though, because it's a little bit more efficient with fewer instances and roughly the same total P&L. So average trade 4% or 4.02 to be exact. Max drawdown much steeper though at 42.93%. We're going to look at that relationship with those metrics on the bottom. In fact, between average trade percent, what I might be looking for on my next trade if I'm going to trade this, and what risk I might be taking based on the worst level in history. So we'll get to that later shortly. But hit rate here is 2 out of 3, 66.67%. Profit factor is, they're all about the same with this test, even with these different hold times. It's just north of 2, which is good. And you can see the big drawdown in the bear market of 2022. Let's go out to a 3-month hold time. And we see 13 instances now. Average trade is 6.14% historically. Total P&L is over 100%. Drawdown is 35.66%. And hit rate is solid here. It's 76.92%. Easier to have a nice win rate or hit rate there when there are fewer instances, but still that's respectable. 10 out of 13 is a nice percent. And profit factor, excellent at 4.197. It's a pretty equity curve here, even though we don't have a lot of instances with this 3-month hold time. Let's go out to 6 months. I debated whether to include 6 months, but why not? We're right here. So total P&L is roughly the same, but only on 7 instances. The average trade, therefore, is north of 10%, 10.31%. Max drawdown is still pretty steep, 42.38%. And the hit rate is 6 out of 7. It's very solid with a 6-month hold. Profit factor also very good, although not quite as good as the 3-month hold. So let's cover a couple of metrics, and then I'm going to use them to compare all the edges that we're looking at today across these AI ETFs. So let's talk left-hand side first. This is the average return percent divided by the max drawdown ratio. So some of you are familiar already with return to drawdown ratio. It's something you see in some backtesting packages and so forth. This is obviously very close to it, but it's average return divided by max drawdown. I like average return because when I'm thinking about the next trade, I'm not thinking about all of the hypothetical money that was made in the past under these conditions. I'm really thinking about, hey, what can I potentially make with a specific hold time or another specific exit? I use hold times here so we can just compare general tendencies. So that's why average return divided by max drawdown is better for me. Now, the idea here is which setup has the best risk-reward ratio. And the formula is quite simple. It's average trade percent divided by max drawdown percent. Now, how to use this? Basically, we can compare risk-adjusted quality across different setups or different hold times in today's case. We can identify which edges or setups give the most bang for the buck, so to speak, in terms of risk taken, and filter out edges with poor risk-reward profiles. Let's look at the other metric, RRTR, which is return to risk time ratio. And the idea here is which setup uses capital most efficiently. So the formula is for RRTR, average return percent divided by max drawdown percent divided by the hold days, the number of days being held, times 100 just to scale it. How to use this for each day capital is tied up. How much risk-adjusted return are you generating compared to the other setups? That is the idea, right in a nutshell. And the higher the RRTR, the more efficient use of capital in time, regardless of the absolute number. And let me stress the numbers of these two metrics that we're going to see now for the rest of this video. They are, on an absolute basis, not that meaningful. They are useful in comparison to the other hold times. All right, so with all that said, let's get to this first comparison. We just looked at AIQ over different hold times, 10 days, 1 month, 2 months, 3 months, and 6 months. Based on that setup, of course, the 7.5% drop inside 20 days. So the RRTR for the 10-day hold is the highest of all these setups. This is the most efficient capital usage, best for frequent redeployment. In other words, best for the aggressive active trader who wants to make more trades and kind of be in and out and move on to the next opportunity. Now, I do not look at these setups in any kind of annualized sense. Well, hey, this is actually an annualized return or vol of A, B, or C. I don't do that because I don't really think that way when I'm just thinking about the next trade. That is important if you're modeling out a whole system or portfolio and so forth, but that's a different discussion. So this really, based on the RRTR, the 10-day hold is the most capital efficient for the active trader. Go to the 6-month hold, and we see this historically delivers the most return per unit of risk taken, and it's the best risk reward for the patient trader. So different ways of looking at the same results and really tailoring it to the kind of trader I might be or you might be and so forth. All right, let's move on to another setup and we'll keep doing this comparison at the end. So ARK W. This is the ARK Fund's next generation internet ETF. We see a daily chart, and this has really been crushed. 25% it's dropped in just 3 months, 180-day low. And this is largely because it has crypto exposure, but not exclusively. So you can see down lower right-hand corner, this just set up with this condition. Sure, it's bounced a little bit, but not dramatically yet. So let's take a look at the stats. And first, the holdings. So you can see Tesla is up at the top. This has an over 10% weighting. So you can see this is very different than AIQ, which is less concentrated and more equal weighted, not perfectly equal weighted, but closer to that. This is very different, right? Tesla over 10% weight, far right-hand column. AMD is near the top, 7.25%. The ARK Bitcoin ETF, we can see Bitcoin exposure here. That's 6%. That's part of the decline, obviously, and many other familiar names. Let's go to the 10-day hold. Under this, dropped 25% in just 3 months and hit an 180-day closing low. This has not happened very many times, right? You've got 2014 to the present, fall of 2014 to the present. So you have a longer window of time than the last ETF, but this is a more demanding setup, if you will. It's more extreme. And the total P&L here is only 23.37% across 7 instances. And the hit rate is not that north of a coin flip, 4 out of 7, right? It's just one trade away from being a 4 out of 8, 50%. So profit factor, nothing to write home about at 1.5, essentially. Average trade here is 2.98% over 10 days. That's respectable in my view. Real max drawdown, 23.69%. That would be rough to get about 3%, but that is the worst figure out of all 7 instances. Let's go out to a 1-month hold, 6 instances now, and the average trade 5.15%, worst drawdown 24.7%, and hit rate 4 out of 6, 66.67%. Profit factor, nice at 3.365. Again, we have few instances. I won't keep saying that, but it's easier to have a better profit factor with lower instances. Nevertheless, that's a good figure. Let's go out to a 2-month hold, and we have 5 instances. Average trade 4.67%, real max drawdown 39.19%. So 60 days, or I should say 2 months, is not quite as favorable here. Profit factor is down to 1.4. Not looking as good over that hold time. Move out to 3 months. And we have 5 instances and a much better average trade here. So we have a lot of risk in that 1 month to now 3-month window, right? That's a lot, 2 more months of volatility price discovery, and in this case, drawdown historically. So average trade 8.87%, real max drawdown 44.55%, but the hit rate is pretty good, 4 out of 5. Profit factor is north of 2 again. Let's just look at 6 months, 4 instances, and here you can see average trade is very solid, 21.19%. Drawdown pretty steep, 58.47%. That is the crypto part of this ETF, most likely adding to that drawdown. And the hit rate, 75%, 3 out of 4, quite simply. And profit factor is still not great, just south of 1.5. Let's take a look at the summary here. And the best, most efficient use of capital scenario would be the 1 month, which has 0.992. It is much higher value than any of these others. So you can compare it and say it's several times more efficient. It looks like about, to its closest competitor, about 3 times more efficient use of capital. Again, with that 1 month hold, average trade 5.15%, and real max drawdown reasonable at 24.7% in my view. 6 months historically delivers the most return per unit of risk taken. And again, this is the best scenario for the more patient trader, the less active trader, and so forth. Let's move on to another ETF. We're going to go to the Global X Robotics and AI ETF. This just made a new 180-day high, right? We've been seeing some weakness. Now we're going to look at a couple ETFs that are showing a lot of strength. Obviously, this is one of them. I've got that box there showing a 180-day high, and there's a couple other places we could define 180-day high. Just depends at what point you're looking at it. But let's take a look at the components or top holdings, and you can see top is NVIDIA, over 10.5%. We also have ABBN, over 10%. We have another global company, Fanuc Corp, 9 and change percent, and so forth. So you can take a look at these holdings in greater detail if you like. Let's move on to the first holding time for this ticker, which is BOTZ, very clever bots. This is, of course, robotics related as well as AI. And again, just closed a 180-day high. We're going to look at hold times. Quite simple. 10-day hold time. Average trade over 46 instances is not exciting, 0.07%. Real max drawdown, 25.49%. So, if I hadn't looked at the stats here and someone had just said, hey, what do you think? Take a guess. Bots makes a new roughly 6-month high. You hold it for 10 days or some other hold times we'll get to. Is it, what's the average trade? I would have guessed higher than this, especially in this climate of AI adoption and so forth. So a little surprised that this is that weak. And you can see total P&L, interestingly, is negative at negative 1% over all these 46 instances. So this is just kind of noise. There's not a lot of signal here. But average trade is positive. How is that possible? That is due to path dependency. The order in which trades occurred can affect the average trade versus the total P&L, and they can look counterintuitive, but that is how that can work. All right, let's move out right away just to a 1-month hold. We'll take a deeper look at some of the later hold times. But here, average trade is negative over 29 instances since 2016. The profitability, interestingly, is north of 50%. So it wins more often than it loses slightly, but total P&L is negative, and average trade is, again, just kind of spinning the wheels, slightly negative, in fact, spinning the wheels and going backwards. So let's go out to 2 months, and we see 19 instances. Not the most beautiful equity curve, but at least now it is positive, and we see the average trade is also positive 1.36%. Drawdown is pretty steep to get an average trade of 1.36% at 36 and change percent max drawdown. Hit rate is much better here with a longer hold time of 2 months, 63 and change percent, and profit factor is above 1. And if we go out to 3 months, we have 13 instances. Average trade 1.55%, even worse drawdown 43 and change percent. Profitability or hit rate now is pretty good. And of course, the average trade is decent, but we don't have a lot of P&L here. And the profit factor is not that great. So obviously, I'm not that excited about bots at this point. Move out to 6 months. Total P&L is nice at 28%. Across 7 instances, average trade 4.87%, drawdown massive at 57.05%. Hit rate is north of a coin flip. Profit factor just remains kind of unexciting here. So these are weak results, as I say in these comments, but the best RRTR, or the most efficient use of capital for the aggressive or active trader, would be that 2-month hold. The most bang for the buck return per unit of risk is the 6-month hold, but quite frankly here, this is an exercise, this summary, because I wouldn't consider either, especially when there are other opportunities we've already looked at that are worth considering. So at least in my view. Moving on to the last, but certainly not least, the semiconductor ETF. A lot of people would argue that this is not an AI-related ETF. Others would say this is the most AI-related ETF, being semiconductors and what they contribute to the whole AI picture and ecosystem. So the VanEck semiconductor ETF just made a 180-day high. And I want to look at hold times, of course. Let's look at holdings first. And NVIDIA, look how concentrated this is, 18.46%. Of net assets as of the close of February 17th, just recently. Taiwan Semiconductor, over 10%. Broadcom, 7 and change percent. So much more concentration here, and this is the most NVIDIA-focused one, of course, as well. So a 10-day hold for SMH, which goes all the way back to 2000, right? May of 2000. This has a deep history. It's a fairly early ETF. Sure, it's not from the early 90s, but it does go way back. And the total P&L is over 67.5%. 141 instances of this setup, right? There are a lot of 180-day highs which have been made historically. And again, with a 10-day hold, average trade 0.46%, real max drawdown 28.45%. We'll look at the other ratios later. Hit rate is north of a coin flip. Profit factor, not exciting, at 1.28. Let's move out to hopefully something more interesting with a month hold. And we see it is more interesting. 90 instances here. Hit rate 58.8%. Much better. Profit factor has improved to over 1.5. And the average trade is now north of 1.12%, real drawdown 29.7%. And it's a jagged equity curve, but it's a bit more enticing. Let's go out to a 2-month hold under these conditions, or this one condition, I should say. And we've got 57 instances, average trade over 3% now. Real max drawdown has increased, no surprise, it usually does with more time, 37.05%. And the hit rate is almost 60%, not quite. Profit factor is excellent at 3.258. And notice how much better the equity curve is, especially in recent times. You can see for a time it wasn't necessarily that great, but it has improved. And let's go out to the 3-month window. 43 instances, average trade 5.77%. That's pretty nice, especially with all of this history, which includes at least 3 bear markets. And the real max drawdown, 34.4%. Profitability is 74.4%. Very nice. Profit factor, awesome on 43 instances, 6.049. That is nice to see. So VanEck semi under this condition with a 3-month hold looking certainly like the strongest to me so far. And 6 months, you see 20 instances, 12.98% average return, or average trade, I should say, and real max drawdown 33.6%. Profit factor is, again, really impressive, 6.898, and hit rate is 3 out of 4 at 75%, 15 out of 20 technically. So let's summarize all of this here. And it's the longer holds that, no surprise, are showing up the best. In terms of the most efficient use of capital, again, for the aggressive active trader, that would most logically be the 3-month hold. This is best for frequent redeployment of capital or recycling or turnover, any way you want to phrase that. 6-month hold, we see this is the best bang for the buck or return per unit of risk taken. And this, again, might appeal a bit more to the patient trader. Now, there's no guarantee that the next trade that I take, you take, anyone takes is going to be on par with the average. Could be better, could be worse, could be a loss. So that's always the case. We never know what's on the other side of that hard right edge of the chart that separates the unknown from what we know. And that is why probability is crucial, right? That's why I'm in love with probability and in love with the puzzle of the markets that we are talking about today and we talk about in every report in one way or another. All right, everyone, thank you so much for watching today's Edge Report. Stay tuned for Monday's All Markets Report, where I quantify across asset classes from crypto, stocks, commodities, macro, and more. And for now, trade smart, live well, and cheers from the Caribbean.